Welcome back to Total Money Management. I'm a bit rusty. It's been 4 weeks since I've been back in the studio, but I'm back with Steve. How you going, mate?
Good, mate. Good. How are you?
I'm well.
How are you? It's been a month.
It's been a month.
What have you been doing?
Oh, well, I've got something
Ta-da!
For the listeners.
There you go.
I'm an engaged man.
You're an engaged man.
Stay
That's
away
it.
from me now, Steve.
Sorry, girls. It's all over. It's all over. Where's that?
That's the Sacré-Cœur in Paris.
As you do.
We spent 4 and a bit weeks where we travelled to the UK to see the family because it's been 5 years since I've been back.
Oh, is it?
Yeah,
Right,
it's like COVID hit, haven't been back. So I saw the family, went up to Scotland for a few days. Paris, obviously got engaged. It was amazing. That's a Sacré-Cœur Cathedral in the background.
Right.
And then from Paris to Venice, did a few gondola rides.
Right, as you do.
I had so much pasta, honestly. I've never had as much pasta in my whole
Well, you
life.
haven't put on any weight.
I put 4 kilos on.
Oh, did you?
Yeah, I'm fatty now.
So you're starved since you come back?
Yeah. If you go through, it's funny, if you scroll through the photos from oldest to newest,
Yep.
you can see my face gets a bit bigger.
Gradually getting puffier. Wow.
And then ended up in the top of the world in the Arctic Circle in a place called Tromsø in Norway.
Wow.
Yeah.
How was that? Cold, obviously.
Minus 15. The snow was up to, if you're watching the video, it was up to this table here.
Right, so about a metre.
About a metre up. Yeah. And we got there, the plane landed. And I'll tell you what, the pilots are like next level because it's just ice all over the runway.
Yeah, you've got to be a specialist.
Absolutely, just landed perfectly, got off, and then it's just sideways snow in your face.
Right. Okay.
My beard had like icicles.
Yeah. I had that in Sapporo.
Yeah.
Same thing. We landed at midnight. I got out. A guy from Queensland, right? We landed in December 12, and of course that it's just like a blizzard.
Yeah, knocks you for seconds.
And I've got out. I'm carrying a bag and a guitar, and it's just like, what have we gotten into?
Like in your busking
and we don't know
days,
where we're going. They'd put us up because it was the government. They put us up in some place, and we, it's midnight. We've been, we went from Brisbane to Tokyo to Sapporo, and yeah. So anyway, good on you, mate. Yeah. Congratulations.
Thank you. I appreciate it. Back to action now. So yeah, it was best time ever. Now I'm skinned. I needed to get back at investing. So
righto, back into Bitcoin.
Yeah.
Righto, come on, 200,000. Here we come.
So look, what we're going to do today is just cover it's been 4 and a bit weeks since we've actually sat in a room and talked about how the global economy and the market's going, but we wanted to cover things like valuations over the last 4 weeks, definitely talk about Trump and Musk and the impacts that
everybody else is.
Yeah. Well, we just want to give people our opinion, I think, because it seems you've got left and right at the minute where people are hating him or loving him.
Yeah. And there's lots of discussion about what he's doing. Is it real? Is it bullshit?
Yeah.
Stuff like that.
We'll talk about some of Europe's troubles, and I can definitely talk about how expensive the place is. Incredible. And then I'm from Barnsley, a tiny town in England.
Right.
And I know it's not in Europe. They're not in Europe anymore, but a pint was £10.
Right. So that's 20, about
it's almost $20.
18, $19.
And where before I left 10 years ago, it was £3.50.
Jesus, that's a lot, isn't it?
There's inflation, then there's whatever that is.
Yeah. I don't know how that works, though. I don't know how it must be cost-driven. You can't just go, I'll just charge £10 for a pint, because everyone else would go, all right, well, I'm charging $7.
Well, I took the boys out and bought them all around. It was almost £100. $200 for a round.
One round?
One round.
That's the one where you go to the toilet.
Oh, yeah, and then then all the partners came. I was like, I'm not having the next one. So, it was a nightmare. Anyway, so there's Australia's economy to cover, property prices, the ASX, a couple of classics, and then we've got capital cycle theory lesson to run through, which is a really interesting one. And we teach that in Well
3.
Well 3.
Yeah.
Which is usually a big hit. So we'll give you guys a bit of an insight into that. But I might pass over to you,
Kick
Steve.
off, mate. Kick off. There we go. Our favourite, Cape and the earnings yield. Just running through there, the basically that chart probably encapsulates most of the sort of macro stuff, big picture stuff about the stock market. Okay, people know we bang on about Cape. People know we bang on about the earnings yield.
I've got my shirt on today.
There you go. Yeah. There you go. You're back in the fold.
Yeah.
And again, what I'm trying to say to people there is when the Cape's high, the earnings yield is really low, vice versa, right? And the reason why I'm saying that at the moment is because Cape, as people know, has been expensive for a long time, right? So again, just saying that I think I wrote in the January newsletter and I said, the friend I had breakfast with went, that Cape's all bullshit.
Yeah.
And that's what you get at the market top, right? You get this argument that the old ways are no longer valid.
I don't understand it because you've got data from 1880s, and I don't understand how you can look at it and go, that's nonsense.
Yeah, but it's just the way. Well, first of all, it's an interesting point, Jacob, because I've also noticed it with economists at the moment with Trump talking about tariffs, right? In the media, there's always they're really good idea, they're really awful idea. Now, we also know that's split along political lines because you either love Donald Trump or you hate his guts, right?
Yeah.
So he's one of those people that doesn't evoke I'm not really sure, right? You either hate the guy or you love the guy. And so that's why America's sort of like so bipolar or...
Divided.
Divided, thank you. Divided at the moment, strongly divided, right? And again, this is the sort of stuff you see when the world is changing. Does America engage in the world or does it say we've had enough of looking after everybody, we're pulling back, right?
But I can't see how, with the Cape, it's obviously really expensive, but every single country is it's not just retail investors invested in the US, it's countries invested in the US. So, and they've got much higher stakes to lose than the average Joe Blogs.
Well, yes and no. You see, this is part of the problem we've got at the moment. The US is so big that the only place a lot of countries can put their capital safely and get a return is in America, right? Now, you've got to remember, the American bond yields are about 4.5 or 5, right? Well, that's fantastic.
Yeah, they're great.
Right? It's better than putting it in Germany and getting 1.
Well, if a country's got a few hundred billion or trillion to invest, they're not going to put it in Australia. It's big enough. You'll buy the whole joint.
That's exactly right. And that's the problem with America being so far in front of everybody. So there's really only one place you can go. And what folks, what happens is it's distorting the global economy. But I'm of the opinion, and there's arguments either side, but I'm of the opinion which says places like Japan, Germany and China have been taking advantage of the United States for about 30 years, right? Now, on that point, absolutely 100% agree with Donald Trump, right? Everyone's been taking the you-know-what out of the Americans, right? Trump is the first one that's basically said, listen, I've had enough of this, right? Now, he was actually saying that back in the 80s, by saying the Japanese were taking advantage of the Americans, and they were, right? Now, you could say, the Americans allowed it or whatever, but that's the situation. So that's now changing. But what you're finding is that, and it's sort of like Cape, you either believe Cape or you don't. Now, most of the mainstream media and finance people don't agree with Cape, and they use every market top where Cape runs for a while or the market runs on longer than, quote, sort of expected. And they go, see, I told you, Cape's bullshit.
Yeah, if you got out here, you would have missed out on this.
This is what happens all the time. And it's not about saying, you're either 100% in or 100% out. That's garbage, right? It doesn't work that way. What we're simply saying is, look, if you invest now, folks, the earnings yield is 2.6 and you can get 4.5 in bonds.
Over the next 10 years,
if you want to invest and get 2.6, by all means, go right ahead.
Yeah.
Now, you might get 20 for the next 12 months.
And then
right?
minus,
But over the next 5 years, you might find yourself underwater. And that's the tricky bit about timing, and it's why we talk about adjusting your allocation.
Well, I was just going to say, in well 2 or well 3 strategy, for example, I mean, even well 1 to an extent, we use different indicators for that. You have a different allocation for these periods of time, and you can feed more cash into it if the market falls.
It's just thinking about your investing over time.
Yeah.
It's the thing, we talk about this all the time, that people get stuck, particularly because the financial media are always talking about, we were just talking about it before, like they're always talking about this week. And then it's sort of like, what happened last week? It's like, oh, that's forgotten. We're talking about this week.
Yeah.
And it's like, okay, but don't they sort of run, congruent to each other? It's like, yeah, but we're talking about this week.
Oh, the media outlets have a frenzy when someone like Trump and even Musk to an extent is in the limelight because it's so different every week.
Yeah. They love that stuff,
Yeah.
right? Because you can write, and you can, it's great when you get Donald Trump saying, we're going to take over Gaza. Holy dooly, we want all of Ukraine. We're going to give in to Russia. All of that stuff generates, enormous clicks and stuff. But is it accurate? Well, it could be. But, we need to look, I think, at the bigger picture, which is, as we've talked about in the new normal, right? The world is really changing seriously. You probably don't realise you're in the middle of a historical moment. And that's why it's really important to pay attention to these indicators, right? And now, the reason why is because every changing of the guard, right, happens with, they either start or end with a financial crisis, right? So we're going to probably end with a financial crisis. Now, where will it be? Well, I don't know, but the Cape's at 38, right? We've had a bull market for 16 years. The last 2 years have been 25%, right? I wrote on the blog, we did a blog post Friday, February, what was that, 21st?
Yesterday from when we're recording.
21st?
Yeah, 21st of Feb.
So 21st of Feb, just to give you an idea, right, I went back and had a look at the NASDAQ, right, because the NASDAQ is now at 20,000, okay? So what was it in 19, and it's a 30-year anniversary, okay? February 25, well, July 25, if I'm right, July 95, sorry. The NASDAQ was at 2,000, okay? So between 95 and 2000, the year, it went from 2,000 to 8,000, righto? 4 times that in 5 years. In the last year, 1999, the NASDAQ doubled, 100%, right? Now, you're talking about the world's biggest country.
Yeah, right? Well, the dot-com bubble pushed
that. The dot-com bubble, right. So then between 2000 and 2003, the NASDAQ loses 80%. Now it's back at 2,000, right? Then it doubles. I think it doubles and gets to about 4,500, if I think I'm right. Then in 2007, it's back at 2,000. So in other words, you go from 1995 at 2,000, you go to 8,000, you crash, you go back up again, and then you crash to 2007, which is 12 years later at 2,000.
And you've gone nowhere.
So in other words, in 12 years, you've had a roller coaster ride where you've gone from being having a few bucks in your pocket to being a millionaire, to having a few bucks in your pocket to being a millionaire, to having a few bucks in your pocket. Now, from 2009,
it's just gone.
It's gone from 2,000 to 20,000.
Yeah.
Right now, that's compound at 15% per year since 2009. Right now, here's the rub: how long do you think it's going to go?
Yeah.
Right. When you look at the history, you go, man, this thing's got a really big crash coming.
Yeah, well, it might not go to 2,000, but it could lose 60, 70, 80% quite
absolutely.
easily.
Well, see,
it's done it before.
That's why I say, in 2000, it lost 83%.
Yeah.
Now, if I said to you, Jacob, it's going to go back to 3,000, you go, Steve, please. Right? And that's why I'm talking, we'll talk later about the capital cycle theory, because the Magnificent Seven are truly bloated in valuation if the expectations around AI are so large that the valuations are completely insane, right? But we'll talk about that when we get there.
Yeah. What we've got next, global equity valuation indicators.
Yeah, just showing people, we always talk about the market being expensive and stuff like that. But there are places of value if you want a long-term perspective, okay? And what we know is we get this mean reversion between large caps and small caps.
Yeah.
Value versus growth. So growth, obviously, since 2009 has had an absolute stellar run.
Yeah, yeah.
Right? Well, now value is coming back into vogue, and I think that's going to be a really good area because the world is changing too.
Yeah.
Right?
So, but would you look at like value companies, or would you still look at ETFs that provide more value than growth?
I'd still look at ETFs generally.
Yeah.
But I was saying to someone yesterday, I'm a little bit over buying companies. And the reason why is because in a volatile environment, which we're in, and I think we're going to get more of, in a volatile environment, if you know what you're doing, volatility is really good.
Yeah.
Okay? If you don't know what you're doing, volatility is a nightmare, right? And so I think coming into particularly for companies, we already know that most companies don't survive 20 or 30 years.
Yeah.
Right? Okay. So it's much easier, and like we talk about in the risk hierarchy, to say, well, look, don't buy the needles, just buy the haystack, right? Buy the whole lot of them. And when you look at that, the risk element is the base of risk is risk and return, right? Yeah. But what you've got to say to yourself is the Australian stock market risky? Right? Not are Australian companies risky, because they are.
Yeah, sure.
But is the whole stock market risky? Yeah. Well, my argument is no, it's not.
No. Is it going to go bust? No.
That's right. You're never going to wake up and go, holy shit, the ASX has fallen in a hole and we've all lost our money.
Yeah.
Right? So that's an enormous difference. The older I get, the more I realise that you don't need to hold companies. You can hold, Well 3 is, 10 ETFs.
Yeah.
Well 2 ETFs. Well 1 ETFs. So from that point of view, it's not necessary to pick companies. And once you get that base idea of now, my point being with volatility, companies can swing like crazy and go broke on a black swan event. Generally, countries don't.
No. You get your Ukraine, Russia type stuff every 20 to 30 years.
Yeah, exactly. Exactly. That's why you get an Argentina, that goes bankrupt in 97 and all that sort of stuff.
But I think, to me, I spoke about it before, but it seems to be a bit of a generational thing where people my age and younger, I get comments all the time saying, what company should I buy? Why? What cryptocurrency should I buy?
Yeah.
And it's just because they want to go from having a few bucks in their pocket to being financially free or whatever you want to call it. Whereas you get older and you've got a few bob, and you don't want to lose it then.
Yeah.
So
it's a look. If you're young, you can lose money and recover
and earn it back. Yeah.
If you're old and you haven't got an income, you can't. You've got to be a lot more conservative,
way more strategic.
Right. Absolutely.
But if you take that approach when you're young, over the long term, you end up doing better off.
Exactly. It's just that young people are impatient.
Yeah.
Right. And I was saying to someone yesterday, another thing of the sign of the top is the FIRE stuff, right? Financial independence, retire early.
Yeah.
And you see that. You don't see that in a depression.
No.
Right? Why not? Because no one's sitting around thinking, man, I am going to get rich on Bitcoin. Right? But they see it in market tops where people are like, you buy crypto, you buy, 4 times leverage gold ETF.
Yeah.
What is that moon and what do they call that? There was that YOLO, right? You only live once, right? That's it's like, yeah, buddy. And if you fail, guess what? You got a life of fucking misery coming, right? Because YOLO, and it's like YOLO. Now you're $500,000 in debt.
Yeah.
That's you know what I mean? You only see that risky behaviour when there's risk taking going on, right? Cryptocurrency, right? You can get rich in a year.
Yeah.
Right? You can also lose all your money, but you can get rich in a year. So, young people don't look at the risk reward stuff. They just look at it and go, man, if I buy $10,000 worth of Bitcoin, I'd be a millionaire.
Well, that's exactly right. It's usually 100,000 either novice or younger people with $5,000 or $10,000, not $150,000 or $500,000, and they just chuck it all in.
Yeah.
So I think that's the major difference that we see anyway. We've got clients now that earn a lot of money that don't want to lose it.
Yeah, yeah. But even, like, as our base point is, don't lose money. What we're trying to say to people is you make money by not losing money.
Yeah.
Right? That's the whole key. Most people don't lose money because they have a job, right? And they have an income and a good income. But there are a lot of people who have got a good income who still don't invest well.
Yeah, no.
It's the only you shouldn't say it the only, but one of the ways they survive is just going, oh man, we just made a $500,000 mistake. Oh, well, that's okay. We get, we're on 700,000 a year between us. All right, well, a couple of years and,
we'll make you back. Yeah.
Well, we'll hold that property because it's not going to make money in 5 years, but it'll be all right in 20.
Yeah. So anyway, going back, so we've got growth versus
Value
value versus growth, and we're thinking that growth's going to taper off a little bit over the next 10 years in comparison to value. What else is there? There's emerging markets that we talk about.
Yeah. The same thing. You look at emerging markets, some of them are really cheap and, quite good. China's having a bit of a moment this year because Xi, I think, has met with the tech dudes.
The tech dudes.
The tech bros. The tech bros to, talk about, getting the private economy going again and stuff like that. That, to me, is garbage because Xi hates what he calls welfareism. That's why they're on shitty wages, right? Because they're doing the Japan strategy. And so in order for Xi to say we'll let the private sector take over, that means less of a role for politics. Well, the Chinese Communist Party aren't going to have that.
Not going to let that happen.
No. So they're just trying to work out a way to harness the private sector to do what the state wants.
Yeah.
Right. But as I've said, the problem with China is it follows the Japan model, which was the Brazilian, which was the Russian model. And, they've got the same problem. They got a hugely overvalued housing market. They got people on low wages that can't consume, so therefore they've got to export everything. Now the world is saying, well, we can't keep taking these exports. So there's a really, really big, shit fight coming because the Chinese have basically flooded the world with exports.
Yeah.
Right? 10% of China's GDP is their exports. That's
Most
enormous.
Most of it's EVs.
Not 10% of their surplus
Are exports.
is exports. So they're just flooding the joint, right? And now the Europeans are suffering from it because they're saying, well, they're going to put, for every Chinese EV you buy, you're not buying a European-made EV.
Yeah, well, Germany's falling through the floor because of that kind of
That's
thing.
exactly right. So, and they've lost Russian cheap energy.
Yeah.
Demographics are awful. So, this is where you get countries starting to argue amongst themselves. Brazil and can't remember the other one has said we don't want Chinese steel, right? Because we've got our own steel industry.
Yeah.
Right? This is what's going on. The countries are being forced to say, we're going to have to save companies. Australia just did it with the Whyalla steel mill, right? We're saving these companies because we know if we don't have them, we can't make our own goddamn steel.
Yeah.
Which means, we go to war, we're stuffed.
Yeah.
Let's make bombs. We can't, chief, we don't make iron anymore. It's like, hello. And that's what's coming, right?
I think country, it feels like, at least anyway, I'm not going to profess to know, that we just don't want to rely on other countries. Look, people don't want to rely on each other as much anymore.
Well, yeah, countries, you can trade with your friends.
Yeah.
Right? So we've got no problem with the UK, we've got no problem with the USA, but we've got a problem with China, right? And the reason why is because when we go back to the 80s, the changing of the guard then was American manufacturing got hollowed out, right? All the factories declined. You saw it in the UK, right?
Yeah.
You said about the coal companies.
Yeah, with
stuff,
Thatcher.
right?
That's still the same now.
Yeah. So what's happened is the emerging markets are looking at that and going, we're not doing that strategy. We want to build our own cars.
Yeah.
We want our own steel. So they're not giving in to China with the free market ideology. There's a lot of people don't realise this stuff about free markets, mate. There's only basically 5 or 6 countries the US, the UK, Australia, Canada, and New Zealand, who go, yeah, it's a great thing. You talk to most of Europe about free markets, and they're like, nah,
No thanks.
we don't want free markets. So the free market era is over, and that's why, I'm saying there's a trade war now. It might take 5, might take 10 years, but I'm telling you, globalization's dead.
Well, one of the major headlines in papers and news at the minute is the tariff. Tariffs everywhere, tariffs on, tariffs off. There's bluffs about tariff. There's freaking 5%, 20%. What is it actually? Well, we've talked about it a bit, but still a part of it I can't quite understand. Like, what does it mean for me, normal Joe blogs?
Yep, it means, well, I was thinking, the answer is always it depends. And the reason why is because you can't just go, oh, tariff's good, tariff bad. Right? That's not the way it works. It works in a whole different raft of ways. A lot of the economists are saying tariffs were really bad in the 1930s. That's what caused the Great Depression. It's all really terrible. Things get more expensive. But my argument is, okay, I've got an 18-year-old and a 13-year-old, right? So my argument is, all right, well, should I have them struggle to get a job because we can buy all this cheap stuff from China? Or should I say, well, listen, everyone should chip in and then my son will get a job at a car factory, right? And my daughter will get a job somewhere, right? But again, this is why they don't want to let go of their manufacturing sectors, because they employ a huge amount of people. Secondly, you get a whole range of jobs, right? So you get the janitor. Well, the janitor doesn't need to be a rocket scientist, right? But he gets to clean the factory floor and he gets a good wage and he, goes to the footy on the weekends and that sort of stuff, right? You don't get that when you're a barista, right? So the idea of tariffs is to create homegrown industries. So what Trump is basically saying is, look, I'm going to tariff everybody. Those countries where they're doing stuff, I'm forcing them to say, well, actually, we should go and set up in Alabama because if we do that, then we're in the American market, we're creating jobs, and we're not exporting from China anymore.
Yeah, because the original theory, 30, 40 years ago was, we'll get everything from overseas, it'll be cheaper, which means that we can reduce costs.
Yes.
It was quite inflationary.
Everyone will get richer.
Yeah. Capitalist. It was quite inflationary at the time where things were getting more expensive, but wages weren't increasing to pay for things that were being made
in the 70s,
in the same country.
Yep.
Whereas now it just seems like we're going back to that again, where things are going to be more expensive because they're made onshore.
Well, yes. But my argument is most of these things are fairly relative, right? So, but you've got demographics is a really important issue that's a bit of an iceberg. It's, it's a slow bleed, so to speak. Yeah. But you've got that. You've got China and the US now at the same situation where the US had to go to Japan, I think in the late 80s, and say to them, you guys have got to stop exporting out of Japan. You've got to come and set up in the US. Yeah. And that's what the Japanese did. They all went, righto, we're all going to go and we're going to put Nissan factories and Honda factories and, Toyota factories in the US, right? And that's what the US agreed to, okay? So the problem we've got is Japan is a friend. China is not a friend, right? So the US is not encouraging Chinese companies to come and set up because, again, you've got to remember all Chinese companies have to report to the CCP, right, the Chinese Communist Party. So and all of those big companies have got Communist Party members in the company, right? Well, you've seen over the last, 5 or 10 years, China's trying to control all its citizens around the world, right? And so the Americans are saying, we're not having that, right? So the Chinese are going, all right, well, listen, let's set up in Mexico and we'll export out of Mexico. Well, Trump has said, nah, we're not taking that either. Yeah. But the Mexican government's going, well, we need investment, right? So there's all these competing interests. Yeah. So it's really, that's why I say to you, it's really, really messy. But the tariffs are an idea that basically says come and set up here.
Yeah, okay. Well, we've got to march to the US's drum anyway. And
Well, generally, yes. Generally, the world is, beholden to what the US has. But again, now some countries are saying, all right, well, actually, we might deal with China. Right? We'll take China as our guardian, not the US. Right? So that's, again, a catalyst, right, for the US going, there's only one big boy in town and that's us.
Yeah, yeah.
Right? And that's why at the moment Trump is talking to Putin, because Putin is not strategically, Russia's not the issue. The issue is China. So what America tries to do is to drive a wedge between China and Russia, like Russia is trying to drive a wedge between Europe and America. And China is trying to do the same thing, right? So you've got all these wedges going on, and everybody's looking at everybody going,
What's next?
Can we trust those bastards? What they did in 1846, right? And that's what's going on, right? So Trump is sort of saying to Russia, look, we'll give you a bit of Ukraine, we'll take the rest of it, and if Russia said that, the Chinese would go, what? Hang on a second, right? Now you're cozying up to Donald Trump, right? Well, that's the way it works, buddy, right? Because Russia had to go to China when they failed to win Ukraine in 2022, right? So Putin was desperate, and so he had to buddy up to Xi. But Putin realises that China's going, man, those dudes have got a lot of resources. We could use all those resources. And in fact, we could overtake Russia. We could take over Russia. This is what goes on, right? So you got all those guys going, oh, man, we sort of want the Chinese, but we don't want them too close because they might, invade Moscow and take over Russia. Right?
You're just like, I'm living in 2025 and this bullshit's still going on between who owns
Mate, it's been going on forever. It's been going on since Adam was a boy, because that's the way bloody people are.
Yeah, yeah.
Right?
Anyway.
It's all about resources.
Yeah, yeah.
Right?
It's an interesting... Well, I'm really quite keen to understand how this tariff situation is going to work over the next few years. I was thinking...
Confusingly.
Yeah.
Right? And I really mean that, because Trump will be doing it on a case-by-case basis. So it's going to be really messy.
Because he's got total control over it, hasn't he? He can decide a tariff or not. It doesn't have to go through any Congress approval.
Well, good question. He can do that under, I think it's the National Emergency Act or something. So he can say national emergency,
Bang.
write a tariff, and someone might argue in the Supreme Court and say that's garbage.
Yeah, yeah.
But the Supreme Court is probably, pretty much in Donald Trump's favour.
Yeah.
And if it's a national emergency, the argument would be, it's a national emergency, tell me why it's not, rather than it's not a national emergency, the onus is on the president to say why it is.
Yeah, yeah.
Right?
Not innocent till proven guilty, guilty till proven innocent.
Yes. Yeah. And you'd be pretty unpatriotic if you rolled up there and went, tariffs are garbage, I'm prepared to stop the president. Be like, yeah, okay.
Yeah, good luck with that.
Yeah.
All right, let's talk sector performance. This is always an interesting one. And I'm not sure that people will be able to see this really.
Yeah. This is the Aussie one, by the way.
Oh, good. So what we got? What's the top bit? Tech.
Surprise, surprise.
Yeah.
What you see there is generally, I just thought you don't get a lot of these
You get
charts.
the zigzag.
Yeah. And again, you see energy's had a really rough time. Tech had a really rough time. Now it's had 2 great years. So again, talking about this mean reversion, right, in sectors. And like you said before, why would I try and pick a company when I can just pick the whole sector and be a lot safer?
So where's this chart from?
Bell Potter.
Bell Potter. So I think what a really interesting pattern is anyway is you usually see the top 4 or 5 and in 1 year become lower or lower in the next few years, and the bottom 4 or 5 become higher.
Yep.
And if you just stop and think about that for a second,
yes,
weird,
you'll start to see a pattern, right?
A weird strategy starts to occur.
Yep. And so if my advice is print it out, get a pen, and print out 10 of them, right? Then get energy and go from do your little line zigzag, right?
2014, yeah.
Okay. And what you'll see is generally you'd be able to go, well, when it's really high, I should probably sell a bit. And then when it's really low, I should probably put a bit in. right? Now, the risk is really low because you're not going to wake up and they go, oh, sorry, the energy ETF went up, blew up.
There's no more energy anymore.
Yeah, there's no more, right? Well, that's not going to happen. And so that's why we say to people, if you asset allocate and rebalance sensibly, you will do well,
Yep.
right? Now, you won't pick the top sector all the time, but you don't need to. You just need to be able to say, I'm avoiding losing money.
Well, this is a good example. So 2016 telcos, I think that is.
Yep.
Is that telcos?
Yep, telco, down the bottom.
So you might have gone, okay, minus 12%, I'll throw some money in here. The next year you've gone, shit the bed.
Yep.
Minus 26%, I'll put some more money in.
Yep.
I've shit the bed again, minus 17. Then it's up, wherever it is, can't even see it.
19.3.
19.3%.
Yep.
And you can then rebalance it 34%.
Yes. That's why I'm saying that the asset allocation and rebalancing part is really important.
Yeah.
Right? And as I say, you can do that particularly well in the US sectors, right? Tech has absolutely murdered it, right? The NASDAQ, right, as we spoke before. But now you look at it, and ours is an exact, shouldn't say exact, ours is a very close replica of what goes on in the US, right? Tech up the top, energy down the bottom.
Yeah. Well, that's surely going to flip as things change. Energy.
Yeah, and it will. And it will. But this is why I say to people, look, I don't know how.
And energy is generally value companies, right?
Yes.
Unless I'm getting it mixed up.
Because it's fairly stable.
Yeah.
Right? Yeah, you get economic growth and energy booms. The last energy boom was because of shale, right? And that sort of stuff. But that's why I'm saying, if you look at tech, it's absolutely killed it. Okay, well, that's fine. Can it continue to kill it? Probably not. But the reason why, the difficult part is because people say, oh, right, okay, how's it going to die? And my answer is, I don't know.
Yeah.
But I'm just telling you, sport,
Well,
this is the way it works.
It's often not. Like, tech's going to be around forever. We want to go to the moon, space, like there's AI, it's always, tech is innovation. I mean, innovation is never going to stop. But in my opinion, people will just get less concerned about it.
Well, nobody gets excited now about the internet.
No, it's just a thing, isn't it?
Yeah. Well, you're when the internet came out, you were like 10.
Yeah.
Well, you've grown up with the internet.
Yeah.
I had 40 years without the internet, right? I remember being in the government where there was 2 computers at either end of the floor and you had to have permission to go onto the internet, right? And it was used by the scientists that did contaminated soil.
Right.
But back then, it was like, it's like all those jokes, where, there's not much of the internet because it wasn't completely worldwide and it was right on the edge and, all of this sort of stuff. Now, people your age can't get off bloody social media.
Yeah.
Right? It's just the way that it develops.
Well, it's only getting more. We won't get into that.
Yeah, well, if you have a look at this one, this is the one I wanted to talk about because can you just flick to the next slide as well? That's the Magnificent Seven.
Yes.
Okay? That's the amount of money they're spending of their income on AI.
Wow.
Okay? So if you have a look at it, they're all in the, I shouldn't say they're all, the big ones are right in the 10.
126% of
Net income on AI.
Jesus.
Right? Now, if you're spending all that money, you really want to make sure that you're right.
I wonder why NVIDIA aren't.
Because they're the supplier of the chips.
Okay.
Right? Now, if you head back to that other one.
Capital cycle
Yeah,
theory.
that's a capital cycle, right? What we're showing there is, again, in a new industry, you get media buzz on sector potential. Think AI. Hey, dude, this is going to change the world. Oh, man, everyone's going to be out of a job. Well, that's bullshit, right?
Yeah.
But this is what you get, right? You get people who don't read about AI going, oh, man, it's going to take over the world. No, it's not. It can't even name the parts of a bicycle properly, right? That's for another time. But then you get initial capital inflows to accommodate demand, right? Everyone's going, oh, man, AI is going to take over the world, right? So what happens? All Amazon, Tesla, they all go, man, we got to spend some money on this thing, right? Now that they're buying data centers, right, because they need the energy, all of this sort of stuff, right? Speculation about growth potential. Okay, AI is going to take over the world. It's going to grow at 800 zillion%, right? Okay. Now, just bear in mind, I'm old enough to know when the internet was around, and this is the same dig, right? Everyone's going to be online. It's going to be like zillions, right? Like, okay.
Yeah.
Growing capital inflows to catch up to growing demand, right? That's where we are at the moment. Now, what's the next one? Peak capital expenditure, lots of hype, lots of marketing, the halo effect with the CEO. Think Sam Altman. Okay, the way that you used to think Travis Kalanick about Uber.
Yeah.
So you get a guy that represents the future, right? Sam Altman saying we're going to have to renegotiate the social contract. I mean, the guy's full of it, right? Acquisitions and expansions, right? IPOs of new companies, but look at the bottom one. Profits decline, right? Now, the problem AI has got is it's not making a lot of money. So they're burning through a lot of capital. Now, if you say, yeah, but that's okay because out the other end we're going to make, $1 billion a year, you go, oh, cool, okay. If you read a little bit deeply about AI, it's not as good as people say, right? That's why I'm not worried about it because we're in the hype cycle.
Yeah, yeah.
Right?
It's like Bitcoin in 2017.
Exactly right.
Yeah.
Now, will there be a role for AI? Absolutely. Will it be as widespread as people think? Absolutely not. Right? Because there's a lot of flaws involved. At the moment, all you're hearing is the hype bit. And you've got to remember, America's really good at this stuff, right? They're really good at hype and stuff, right? They do it with the internet, right? We're the internet bubble, right? Like I said, the NASDAQ doubled in 1 year in 1999. Yeah. It went up 100%.
The people that know what they're doing to make money get in and out. Everyone else is left with their pants down.
That's exactly right. And the retail investors are always the one that get handed their bum on a plate because they're the last ones in.
Yeah.
Oh, I got to get in on this thing, right? So then you get initial decline of capital cuts. That hasn't come yet. So we're still in the upside, right? Growth slows, investors start selling, analysts reassess companies. Oh, maybe ChatGPT is not going to overtake the world after all. Right, but at this point, everyone's got googie egg on their face, going, "Oh man,
it's a new shiny thing, right?"
Well, yeah, but it is in the green part, right?
Yeah.
In the red part, this is where people start going, "Oh, maybe I overhyped it a bit."
It's a bit sour. Yeah.
Well, people start coming to you going, "Jacob, what's all that bullshit about? You're talking about AI, mate. This thing's garbage, right?" Yeah. You have to then defend it.
Yeah.
Right, and this is what economists do, right? Bankruptcies. M&A, right, and then blame industry is dead. That's when you start to have a look at it.
Yeah. So that's after the dot-com bubble, because, I mean, we can't deny that the internet has changed the world, right? But what we're saying is instead of getting in the height of 2000, have a look at it.
Have a look at it in 2003 when it's crashed 80%.
Yeah.
Right? That's because, again, what you find is there's the Mag 7.
Yeah.
Right? Not all of them will probably survive, right? So you have to look at it and say, okay, I'm going to wait for the dust to settle, then I'll see who's left. Then that's when you'll get value, right? Because at the moment, all of those PE ratios are absolutely crazy. Excuse me. And it's all based on, Steve, but ChatGPT is going to take over the world or whatever Microsoft's is and...
So you got innovation. It was like that with Facebook Meta, like the AR, the VR stuff.
Yeah.
That no one talks about anymore.
Yes. So read Robert Schiller's Irrational Exuberance, Chapter 6, New Era Thinking. Right, he goes through this perfectly about the hum is always around technology. Right, why? Well, you can't get excited about oil. Oh man, the oil future's amazing. It's like. Oil, we've had it around for 100 years. Yeah, true. But if I talk about AI, people are going, oh, man, I've got to get in on this.
Yeah. Right?
Where do I get a piece of this, Steve? Hey, I've got a fund you can buy some. Oh, let me into it. Whereas if I come to you and say, oh, look, you should buy oil and, the stodgy old companies, you go, really?
Boring.
I'm not going to make any money out of those. And it's like, well, you will if energy's at a PE of 8.
Yeah.
Right? But that's the way it works.
All right. Well, we'll leave it there. It's good to be back. I just wanted to mention there's loads of resources on the website. So totalmoneymanagement.com.au. We've got low rates, high returns chapters for free. We've got the week that was, which we talk about now. There's about 4 or 5 different free resources. So check it out, download it. And if you have any questions, reach out.
Good to have you back.
Thank you.
Cheers, mate.
See you next week.
As always, remember, we don't provide financial advice.